This episode of the MSA Rental Market Update, we are looking at the Houston rental market for multifamily properties inside of Houston, Texas. So we can get an idea of where the metro statistical area is drawn out by CoStar. Here on the map, we can see we have San Antonio to the west, Austin to the west, Dallas to the north. Here is Shreveport, Louisiana, Beaumont, Texas. Right here is the Louisiana state line. We got Lafayette, Baton Rouge, and New Orleans. Okay, here's Jackson, Mississippi up here. Gives you an idea kind of where it is. Here is the U.S.-Mexico border and obviously the Gulf of Mexico. If we scroll over just a little bit, there's Mobile right there just kind of hanging out. And that's where I live. All right, anyway, it's about an 8-hour drive to Houston from Mobile. So what filters are we going to look at today? So as usual, we are excluding all corporate, military, senior, and vacation. And we are only including market and market affordable, so we are only looking at conventional apartments. If I go to location, you can see that we are in market, metro statistical area, and Houston, Texas. Okay, so let's go take a look at the Class A, the Class B, and the Class C space all combined. And then we will look at them individually. So let's go take a look at the rent analytics and see what it has to tell us. So here is the supply snapshot for the Houston metro statistical area. You can see that there are 4,745 properties in the metro area that are conventional apartments. That's from 2 units up to however many units there are on the largest property. The total number of units in the market is 683,079 units. There are still 26,148 units under construction, and in the last 12 months, only 1,038 more apartments rented than went vacant, and in 2021, 35,483 more apartments were rented than went vacant, so a huge drop in the number of absorption, and the vacancy is showing that. We've gone from 7.7% a year ago to 9.6% today. There is still showing a little bit of an increase in year-over-year rent. We will go and see what it is month over month in a minute. As usual, we are not looking at the capital markets. We are only looking at the space markets, which is our rental information. If we come on down, we can see the long-term occupancy average for the Houston metro statistical area is 90.71%, so basically 91% occupancy, and it's sitting about 90.5%, so slightly on the bottom side of that long-term occupancy average, but we could argue it is sitting on the long-term occupancy average. And since we have units under construction and we see year-over-year rent growth and absorption coming to a stop, we can assume that at this point is going to be between the oversupply phase and the recession phase of the market cycle. So let's see if we can go prove that by looking at the data for all asset classes combined, A, B, and C, and then we'll go look at them individually. So here is the rent analytics for all 3 asset classes. As usual, we do not look at asking rent. We don't care what they are asking for rent. We only care what they are collecting. First quarter of the Houston Metro for 2022, they collected $1,263, went up to $1,286, slightly down to $1,285, and slightly down to $1,280. So the downtrend has started. It looks like it broke right there, that apex point hit between the second and third quarter. And we have seen that in a numerous amount of markets that we've looked at so far. So it looks like as interest rates started to go up in first quarter of 2022, that really affected between the second and third quarter of 2022 in most of these markets. Let's look at what has been delivered and what has absorbed. So we can see there were 5,409 units delivered. That's a big number. And only 1,295 absorbed. That is not a big number. It made up a little bit in the second quarter, 3,271 delivered, 2425 absorbed. Still not where we want to be for absorption, but better than what we saw in the first quarter. And then this thing starts to fracture really bad. I'm surprised these rents stayed as high as they did. That tells me I bet the Class C market is probably propping the rents up on this, but we'll see what happens. So another 4,239 units were delivered, brand new, vacant to the marketplace. After 8,700 were delivered in the first 2 quarters and only about 3,700 absorbed. Now another, so that's a 4,000 units went vacant in the first and second quarter. Another 4,239 went vacant in the third, and then another 758 went vacant, then another 3,089, and then another 1,507. Okay, folks, this is not looking good for Houston. This is bad, bad, bad for Houston. You still have 26,000 properties left to deliver to the marketplace that are currently under construction, and you can't even remotely keep up with what has happened. If we look at this, I mean, we've only got about 1,600 total absorption for the entire year, and we're sitting at 12, 15, 16,000 units delivered. That is not a good tale to tell. Okay, so let's see if there's an individual asset class dragging it down, or if all 3 asset classes are reacting appropriately. So let's go take a look at our Class A space. So here is the Class A rent analytic data. There are 680 properties totaling 197,890 units. Looking at effective rent in the first quarter 2022, we started at $1,673, went up to $1,709, down to $1,699, down to $1,688. So the fourth quarter rents were actually lower than the second quarter rents. Let's see what our deliveries and absorption tells us. So it looks like we delivered 3,296 in the first quarter, only absorbed 1,918, delivered another 269, but it looks like it caught up a little bit. So what do we got? About 3,500 here and about 3,600 here. So, or 4,600 here. Yeah, 3,600, 4,600. So yes, so we had more absorption in the first 2 quarters than we had deliveries. Okay. Then we had a 1,391 deliver and only 929 absorb, then 1,144 deliver and 387 absorb. So we are seeing some positive absorption in the A's. So the A's are not the asset class dragging this market down, which probably most of you are thinking might have been the case. That is not the case here. You can see that we actually ticked up in occupancy. We were at 90.5. In the first quarter, and we actually went up to 91.3 in the positive direction because of the first 2 quarters. Now, obviously, it lagged in the last 2 quarters, and it's coming back down to where it was. But because of the strong absorption in the first 2 quarters, it helped this market stay fairly strong, which is interesting considering the rents that we saw. Albeit they were small declines, they were still declines. But nonetheless, there was a slowdown, and the rents were affected appropriately by that slowdown. So Class A space doing what it's supposed to do per demand supply factors. So let's see what the Class B looks like. So here is our Class B rent analytic data. We have 1,346 properties totaling 261,489 units. Looking at effective rent, we started the first quarter at $1,197, went up to $1,216, stabilized at $1,216 between the second and third quarter, and then down to $1,208 in the fourth. So let's see what deliveries and absorption tell us. So we can see we delivered 2,112 in the first quarter, and an additional 160 went vacant. So we can see where some of this fracture is occurring in this market. Then another 2,910 delivered, only 819 absorbed, another 2,848, only 206 absorbed, and then another 1,682 and 55 more went vacant. So out of 1,000 units, it looks like we're sitting at about 850, between 800 and 850 total absorption for the year, when we had, 5,078 88, 90, almost 9,500 total units deliver and only 700 to 800 units absorb. So that is not a good number. The Class B market is definitely fractured. And we can see that because it was at 92.1 occupancy in the first quarter, and now it's down to 89.9. So the Class B market is definitely dragging Houston down. All right, so seeing that, let's see if Houston's Class C market is reacting appropriately to demand and supply, or if it's being artificially propped up by the owners. We'll find out. Stay tuned. Here it comes. So I have not seen this data yet. So all this drama is for good reason, because, the rest of the country, about half the properties are being artificially propped up and half are reacting appropriately. The bad half being in the Southeast. Well, let's see what this one shows us. So we have 2,342 Class C properties in the market, totaling 221,400 units. Looking at effective rent, we started at $944, went up to $958, went up to $966, went up to $971. Not a good sign that it's acting appropriately. But again, I haven't looked. Vacancies in my view here, but I have not looked at it yet. So let's go sneak right over here to the vacancy column and see what's going on. And sure enough, vacancy has increased precipitously, yet rents are still increasing. Okay. And a 9% vacancy is appropriate. Even at 8.1, we're starting to think, maybe we need to start reducing some of these rents to get our occupancies back up. But no, that's not what they did. These owners continued to raise these rents when the demand clearly is not there. And when we look at absorption, I bet is going to show negative numbers all 4 quarters. And as suspected, it sure in the world does. So in what world or anybody's mind, when you see negative demand like this, should you be increasing rents? The answer, you should not, unless you have really, really low vacancy. And in this market, we do not have really, really low vacancy. Matter of fact, we're right down on about that long-term occupancy average now. So the fact that we're down at this low of vacancy, or this low of occupancy, high of vacancy, tells me that, once again, the owners are unethically just raising rents because they think they can. Well, guess what, folks? The renters are tired of it. The residents have said, that's all we can stand. We can't stand no more. And we're just going to start roommating up, and we'll see how that affects your demand. And this is what happens. So we are going to definitely start to see this Class C market fracture as we move forward. So that said, this pretty much confirms that the Houston metro statistical area is sitting on the long-term occupancy average between oversupply and recession, and is going to continue heading downward. We're seeing negative absorption in 2 of the 3 asset classes, more in Class C than any of the other ones, but the Class B market is definitely dragging down the overall as far as the rents were concerned, and the Class C is dragging down overall as far as demand is concerned. So that's it for Houston. That concludes this week. This has been a really good week. We've had a couple of really good markets this week. Stay tuned next week, where we're going to do Minneapolis, Minnesota on Monday, Charlotte, North Carolina on Tuesday, Raleigh, North Carolina on Wednesday, Phoenix, Arizona on Thursday, and then Fort Collins, Colorado to finish out next week for our MSA rental market updates. You guys have a great weekend, and I will see you on Monday. Bye.